Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. The segment's brought to you by BOMI.org. That's BOMI. They are the standard for education in facilities and property management. Check them out at BOMI.org. Well, today we're talking about the economic outlook and the impact on real estate moving forward. My guest is Casey Conway. He's a senior economist with CCIM Institute. And before the break, we were talking about, rising rates and the debt that real estate and properties have on them at this point in the cycle, and maybe even consumers as well. So, what do you see moving forward in the debt world? Do we have a lot of debt compared to the last cycle on commercial real estate?
Yeah, great question, Michael. So, people think with Dodd-Frank we solved all the, CRE concentration problems and debt problems, and everything's perfectly rebalanced. So I am concerned. I called at the beginning of this year for 4 rate hikes. People thought I was a little crazy, and I projected it would be in a hike, pause pattern, which we've seen March, June, September. I think we get another one in December. And so people have got to kind of go back in our real estate world and dust off the old band of investment theory, where you look at your cost of your different capital structures between debt and equity and see what that tells you about a cap rate. Well, at a 2.5, 10-year Treasury, interest rates where they were a year ago, you could justify doing deals at a sub-6 cap rate deal. Now we're at a 310, heading toward 325, 350. It's going to get increasingly difficult to justify those deals based on your capital structure at below a 6.5 to 7. So I think what it means is the fundamentals got to come back. You got to adjust to, we're in a higher cap rate environment. This isn't the end of the world. People forget in 2004 to 6, the economy was pretty good. The Fed raised rates 16 times, and we got back to a 5% 10-year Treasury. I think we're headed back to a 5% 10-year Treasury over an 18 to 24-month period of time. And what it really means is the fundamentals, if you have that kind of cap rate or debt cost increase, is you got to look to NOI growth. So are the fundamentals there? Is the economy growing? Do we have the job growth? Are those there? So I don't think the Fed is through. I think they do raise in December. I think we get 3 more hikes next year, and off to the races we go.
So 3 more rate hikes next year. So you think you will have a corresponding cap rate increase of some amount, right? Because of that spread, that investors are just going to have to do it.
Yeah, historically it lags by about a year to 18 months, the cap rate move, because you have financing in place, you have commitments. My big concern is those that have construction loans that are maturing and they've got to go into the permanent debt market. So the CMBS securitization market, the life company market, they're already readjusting those expectations now. So I think the hit comes really into the permanent debt market when you've got to move something that you've done a value add or a construction, and you better be doing sensitivity to look at what a 6.5 or 7 cap rate is. Probably one exception to the rule: industrial. I don't know if there's any, they're defying gravity. Everything's about supply chain. The new retail is industrial. So I think industrial stays strong. I think apartments, it's stable. We're getting 2 to 4% rent increases. Costs aren't going up, from the operation standpoint that much. So I think you can make it work on multifamily, but you can't just keep pushing and assuming it's all going to be luxury. You're going to have to work with that mix.
And I guess the cycle has to turn at some point. So how do you feel about the levels of debt we have in commercial real estate as compared to the last cycle?
So I'm very concerned about it. I'm working on a paper right now that'll publish this fall. Are we about ready to repeat history again? And I think we are. So first thing, we look at concentration levels. We have more commercial real estate concentration in the banks today than we did pre-2008 and 9. We got about $4.1 trillion of total commercial real estate debt if you include the construction loans. If you back out, that's like Reese, Victor Kellogg does a good job with that. They're just acquired by Moody's. If you back out the $800-900 million of construction loans, like the MBA does, it's about $3.2 trillion. And we're about 55% of that's in the banks. So Dodd-Frank didn't solve that problem. We're back to the concentration. CMBS is doing well, but it's at about 110, maybe 120 billion. of the $230 billion it used to be. And what's filled the gap is all these alternative lenders that are not regulated, the mezz debt lenders. And so we've got a lot more leverage in there that the regulators haven't been looking at or anticipating. So I'm very concerned about the leverage.
And is that where you see the increased debt issue is in these alternative financing, the mezz debt? Because it seems like the lenders, when we do CMBS loans and bank loans, it doesn't seem like underwriting's been really relaxed.
No, no. It's an interesting question you ask is where the underwriting's relaxed. I just interviewed a number of major banks, regional, community, and national. I said, we always hear this in the Fed survey of lenders, that they're relaxing underwriting. Give me a concrete example where underwriting's being relaxed. So one regional bank did a real good job, and I'll give you two examples. So in a construction loan today, we see deals being originated by large banks coming down to us to participate that have no bonded contractor requirements and no retainage requirements. So generally you get a bonding on a contractor to ensure they do what they want, or maybe you're not certain about their capitalization. So if you're waiving bondability because either they don't want it, they can't do it, you better be retaining stuff for a year or so afterwards to make sure all the things got through on the punch list. And they're seeing both of those items go away. So I think when we hear relaxing of underwriting,
and that's for commercial loans.
Yeah, commercial loans.
Not residential homes.
No, not on more of the multifamily shopping center office building type stuff. So that's a good example of where the underwriting's deteriorating. And I think the other is, you can really leverage these deals up. And the other part of it is, what's the value? So, tell me a deal you've seen recently, Michael, where the appraiser finally didn't figure out he better appraise it for what the contract price is. So if your contract price is on 5.5 or 5 cap rates today, and those are going to 6 or 6.5, and they're not, and we see that adjust, and you don't see the NOI growth, maybe these values are at the peak of the cycle.
Maybe, but do you see that there's developers or investors have been overzealous? I don't see, at least in the deals that we do in the Southeast, I don't see buyers really overpaying, it seems, for at least, maybe I can't get them to overpay. I'm a terrible broker for my sellers. Right? No, I'm not. I do a good job.
You're a good broker.
But it doesn't seem like we're really overbuilding. Are we, or we're overpaying?
No, I think where we're at in this cycle is, I call it the complacency part of the cycle. We're comfortable with where we are. We're comfortable with a 5 to 6 cap rate range. We're comfortable with there's a debt structure out there. You can find a lender. You can find a permanent option. And what happens is generally something disrupts that. Is it tariffs? Is it the November elections? Reversing the tax code? Is it the Fed continuing to march up and make these debt deals more expensive and we can't afford it? It's usually that disruption. So I think we're in a comfort zone, and I call it, psychologists have a study on this area, they call it recency bias. And you get biased towards what's currently happening. You're recent and you're not looking forward. And I think that's the risk where we're at in the cycle. Everything's comfortable, and we got to be looking forward to see what could disrupt that.
Yeah, I see some of that, where I see sellers that, hey, do you think this is a good time for you to sell? Maybe take some cards off the table in your business, and someone, no, everything looks good right now, everything feels good. And to that point, where do you think the cycle is? How much longer do you think these good times keep rolling? It seems like all the indicators that you've talked about in the first segment are very positive. Where does it change?
Yeah. So we're in baseball season. We're happy in Atlanta, and whatnot. I think we're at least in or through the 7th inning stretch. And I think the answer to where we end up in the cycle is honestly what happens on November 6th. And we were joking a little bit before that I think we need to pay attention to what's the business headline on November 7th. And I think it's going to be one of the two following. Back to work making America great again, if the Republicans retain control and business doesn't worry about the tax acts and everything being reversed out. Or it's going to be, oh my God, we're all going to hell again. The economy's going to hell again. And I honestly think it's that we're that bipolarized in the economy. But the foundations I'd pay attention to, look at things like the National Federation of Independent Small Business Optimism Index. Look beyond the government data. The NFIB, which for 45 years has been tracking small business, what's bugging them, how happy are they? It just set a 45-year record in the history of the survey for optimism, even with the threat of tariffs and whatnot. So look at the ADP numbers. 165 of those 230,000 jobs were small business. That's what's propelling this country today. And we haven't even begun to fully realize the benefits of the Tax Act. Most of the Tax Act, people were understanding and digesting it the first half of this year. Businesses were kind of making the planning strategic decisions with their accountants, attorneys, and whatnot. Those actions and decisions will be deployed here the second half and through next year and probably into 2021. So if Congress doesn't reverse and we don't reverse the tax acts, I think we really see the stimulus come from that. The benefit we've seen so far has really been deregulation. Businesses and NFIB will tell you the number one thing that's made them optimistic about growing and expanding is the deregulation that's happened so far.
Yeah, regardless of how you feel about our president, the economy has just been incredible. And and you're saying, I guess it's the deregulation, it's the tax reduction, it's the change in the tariffs and trade wars there. You know, all the things that he's doing are really helping the economy. And you feel like that, hey, if Congress changes, if the Democrats get more power, that could really change very quickly.
I think it is. The economy is very psychological in orientation. It's a game of psychology, and you can look at NFIB, the National Association of Home Builders surveys, all the business and consumer optimism indices, all the way up until November of 2016. They were struggling. They were down, and after the elections, the optimism, the psychology was a switch has been turned, and it's set new records almost every quarter. So the psychology is clearly, whether you're pro the president or not pro the president, the psychology is very much with him and his policies. Yeah,
that's interesting. We have had properties under contract where the investor said to us that, look, while I'm in due diligence during an election, and if it goes one way, I'm canceling. If it goes the other way, I'm in. Yeah. So you're seeing direct, quick economic impact on it. But how many economists do you think would agree with you and that who's the Democrats, Republicans in power, and maybe things have changed at this point, but how many would agree with that? Because I know you're not a political person, you're an economist, right? So you're looking at the numbers. So how many economists kind of think that way, if you will?
That for the president,
or maybe not for the president, but think that if the president's gone or the elections in November change the status, that it will have an impact. You think some people would say, nah?
I think too many economists are naive in their orientation, that the politics and the psychology don't matter. They go very much hand in hand. My time when I was at the Fed, 2005 to 10, I was kind of that rogue industry guy that would knock on the door, the chairman's office, and say, I know all your board economists tell you this, but none of them have bought a house, made a mortgage, bought a car, and they're writing policy on all these things. We're your industry people. Let me explain a construction loan. Let me explain securitization and why we couldn't do an RTC type deal. They're largely academic. They haven't been practicing in the industry like yourself or me. Most of my career has been a practicing person that, I figured I had two things I could do. I could become a weatherman or an economist, and I figured I'd be a little more accurate than the weatherman, so I became an economist when I grew up.
I'm glad you did.
But I think they're naive, very much naive at it. And I think you need only look at, last week in the Supreme Court nomination hearings and how bipolarized this country is. And my fear is that neither entity can really afford a decision to go against them in November. And what does that mean in our psychology?
Yeah. Well, I think it's real interesting. And I'd like to get some other ideas from you of what you think could go wrong and what could go right. Because we're always trying to skate where the puck is going in commercial real estate or real estate in general. So stay with us. We'll take a short break. I'm Michael Bull. This is America's Commercial Real Estate Show. We'll be right back.